I just want to cover, it is being recorded for just some housekeeping items, because this is a CE seminar. For insurance CE, CFP, CPE, and CLE credits, you must complete and submit the respective CE and evaluation form to me in order to receive credit. Dara will put those links to the CE forms. Actually, if you could do that right now, Dara, that would be great. If you need more than one type of credit on the main form, just check off the boxes accordingly, and the instructions are right there. As far as codes, for CPE, you need 6 codes, CFP 4 codes, and CLE there is a different form on the main form that the link will get you to. So there's you need 4 codes for CLE. And insurance CE, you need 4 codes as well. And if you could submit the form by noon today, most of them are online, or email me, and the evaluation form would be great so we can do a better job next year. There is an insurance CE disclosure that was also sent in the reminder emails. Dara will put that link to that as well. So we covered all the CE requirements, and you're able to receive credits that you are seeking. The mandatory verification codes, it has to be filled in those forms. So I think, yeah, that's the the CE one. We want to thank our long-term sponsors, as without their support, we would not be able to host this seminar for you. Like I said, we've been hosting it for 20 years at the Crown Plaza, and this is our 2nd virtual format presentation. So hopefully next year we'll be able to do something in person or different. We will keep you posted. Our gold sponsors are Bonadio Group, Crucial Partners, Estate Planning Council of Central New York, and NBT Financial Groups. And also the next slide, the special thanks to our sponsors who made the CE possible: Financial Planning Association of Central New York. We have Mackenzie Hughes for the CPE, Dermody Burke and Brown, Prudential, Ligata especially, and the Society of Financial Service Professionals is providing the insurance CE. So thank you. We really appreciate our sponsors for this. And now I will introduce our fearless leader, Peter Dunn, and he will he'll introduce Dr. James. Peter?
Thanks, Pragya, and welcome everybody. Good morning. I'd also like to thank our sponsors, without whom we couldn't have been able to do this. In particular, I want to highlight the fact that this seminar is a product of an ongoing collaboration with the Estate Planning Council, which we've had for, I think, more than 15 years now. So we really appreciate that effort and the work that we've been able to do together to bring great speakers here to Central New York on the topic of charitable planning and philanthropic planning. I'd also like to recognize our current and former board members of the Community Foundation, as well as members of our Professional Advisor Council. Not a lot of things we can do in a virtual environment, but please feel free to wave furiously, and thank you again for your engagement with us. Our board and our Professional Advisor Council are key resources for us as we strategize on how to build charitable giving and philanthropy here in Central New York. A couple of quick Community Foundation highlights before I introduce Dr. James. This past August, the Community Foundation surpassed $400 million in assets for the first time, which is a pretty epic thing. And we're continuing to thrive as an organization. Last year, we distributed more than $20 million in grants, 3,700 individual grants, primarily in the Central New York region, and received almost $28 million in gifts. Notable because we talk a lot about legacy planning and transfer of wealth and related topics, is half of those gifts were in the form of bequests, residual bequests benefiting the Community Foundation that were the result of significant engagements with local professional advisors and their clients. So we thank you for your engagement with us and for the tangible results that is achieving in the form of creating additional permanent charitable capital for the benefit of our region. A theme this past year really was resilience. Really going back 18 months now, when you think about the emergence of the pandemic and all sorts of associated issues. The Community Foundation was the home of COVID community support funds benefiting multiple counties across the region. We received and distributed $2.3 million to hundreds of nonprofits over a period of about 6 months in collaboration with United Way, with other funders and state and local and cities and local governments as a means of really supporting nonprofit organizations who are on the front lines of addressing community response to the COVID pandemic, especially in support of those who were profoundly affected economically because of the pandemic. Our nation has seen a significant reckoning around issues of racial equity, and the Community Foundation made $1 million commitment through our Black Equity and Excellence Fund to support Black-led and Black-governed organizations here in the community. And we've already distributed more than $500,000 to those organizations and highlighted a lot of their stories, trying to build equitable solutions in communities focused in the city of Syracuse. And we've learned a lot and had a lot of engagement with community foundations across the country around that work. A couple of other quick highlights. As many of you know, we've been the home of the Say Yes Scholarship Program for more than a decade, the Scholarship Promise Program for students in the city of Syracuse. This year, we brought on the staff of Say Yes to be a part of our team, and we distributed more than $1 million in grants. Every year, Say Yes benefits more than 1,000 kids in the city of Syracuse to provide last dollar scholarships, and that's a key part of our scholarship work here in the local community. The last thing that I would mention is we continue to really focus and be interested in ways to help nonprofits grow and thrive and do their work better, whether it is through using data to measure their performance, whether it's through mergers and consolidations, or through programs that help executive directors and senior staff do their work better. So Community Foundation is a key advocate for nonprofit capacity and how nonprofits can do their work better and have a better and more sustainable impact in the community. We're really thrilled today to welcome Dr. Russell James to our community. Dr. James is a chaired professor in the Department of Personal Financial Planning at Texas Tech University, where he directs the on-campus and online programs in charitable financial planning and plan giving. Prior to his career as an academic researcher and professor, Dr. James was a director of plan giving and fundraiser at the Central Christian College in Missouri, where he also ended up serving as president for some time. Dr. James graduated cum laude from the University of Missouri School of Law, where he was a member of the Missouri Law Review, and he holds a PH.D. in consumer economics from the University of Missouri. He's published research in more than 40 different peer-reviewed journals, many and been quoted and been a resource in many national publications. He's a frequent speaker across the country and at national seminars as well as seminars across the country. And we're really thrilled to have him join us today. So with that, please join me in welcoming Dr. James to Central New York.
Well, thanks so much. I'm looking forward to sharing some ideas and some new things we can do, especially in the last few weeks of the year here with some of the special charitable planning opportunities we've got at least until the end of the year. And we're also going to be looking at some research on how to have conversations, of what words to use, what's most motivational to clients along the way. So a bit of a mix of law and tax, but also some behavioral economics and some finance concepts along the way. By the way, as we're going through, if you have any thoughts or comments, questions, feel free and write those into the chat, and folks will be taking a look at those, and we'll either get to those during the presentation or definitely at the end, if not during the presentation. So please do at any point. Thoughts, comments, snide remarks, whatever comes to mind, whatever keeps you awake this morning, that's great. So it's good to be joining you here. We're at Texas Tech University, which is almost the New Mexico border. So there's no sunlight at all where I'm at, but maybe by the end of the presentation, we'll get a few shades coming in. So as you may know, there are some special one-time opportunities that we've got for 2021 that can really impact charitable planning. So some of those have to do with legislation that's expiring. So we'll be talking about this year only you're able to eliminate up to 100% of income with charitable deductions. Usually the limitations are much lower than that. And we'll talk about ways that we can actually leverage that, perhaps combining that with Roth conversions or other income spikes, and how we can combine charitable planning with some other financial planning opportunities. And also, we are experiencing some of the lowest interest rates in history. And we'll see all the different ways that that low interest rate, called the Section 7520 interest rate, can impact charitable planning. And ways that we can take advantage of that. We hit the very bottom rates about a year ago, just now starting to creep up. The lowest rate was 0.4% that happened a year ago. We've now creeped back up to 1.0%, but maybe a really good time to take advantage of those low Section 7520 interest rates right now before things change, as we look at the possibility of those interest rates creeping back up. So we'll look at a lot of different strategies to take advantage of those as well. So we're going to take a look at the ideas of first the strategies, that is strategies of charitable financial planning. And then we're also going to be taking a look at how things have changed. So in many cases, we're not talking about brand new strategies, although in some cases we are, but rather we're talking about how many of those strategies have become different, or in some cases far more powerful because of the current environment that we're in. Now, beyond all that, we've got some strategies that have always been a good idea, that have always been very powerful, but now, well, there's a bit of uncertainty as to how much longer some of those strategies might be around with a lot of the legislative uncertainty. And so maybe some things that we want to talk with clients about sooner rather than later. So we'll talk about those as well. You know, one of the things to keep in mind is that when it comes to charitable planning, the most powerful type of asset that we want to work with is an appreciated asset, because whenever we have an appreciated asset, we've got all sorts of ways to postpone or completely avoid capital gains taxation. And so that's one of the areas where charitable financial planning can become so powerful. You know, look, we've got a lot of appreciated assets right now. And actually, even at the very bottom of that sharp drop that we experienced during the earlier period of the pandemic time, those assets were still worth more than they had been, say, 3 or 4 years ago. So we still had appreciated assets, even at that very much low point. Beyond that, of course, those assets have gone up dramatically since then. And whenever we've got appreciated assets in any form, that's where charitable planning can become very powerful. And we'll look at some strategies where that is the case here in just a moment. Now, of course, even during the drop, we still had a lot of appreciated assets, not just because in general, the market was still higher than 3 or 4 years prior, but because some things did really well. And that's usually the case in any markets that, well, some things go down, but some things go up. If you had invested in gold or Amazon or by the way, Clorox, that was a great investment. If you thought of that before all of this happened, a lot of investments went up dramatically. So again, the point comes back to charitable planning becomes very powerful whenever there are appreciated assets. And we typically can find those in any circumstances. So why are we talking so much about appreciated assets? So let me start with the most basic, the most simple concept when it comes to charitable financial planning. If you have a client, and let's say that client writes a $10,000 check to their favorite charity, what is the benefit from a financial planning perspective of writing that check? Well, the benefit is a tax deduction. Maybe the client can use it, maybe they can't. Only about 10% of folks are still deducting because the A standard deduction, of course, doubled back in 2018, so fewer people are itemizing. So they can get a tax deduction of $10,000 for that $10,000 gift. However, if the person instead made a gift of appreciated assets, let's say they had some shares of stock, publicly traded stock that had gone up in value. If they've held that stock for a year or more, they can get a tax deduction of the same size. Writing a check for $10,000, donating stocks for $10,000, it's a tax deduction of exactly the same size. However, in addition to that, we're able to avoid all of the capital gain on that appreciated asset by donating it rather than selling it. And that's a benefit that we get regardless of whether or not the client is itemizing. So we can take advantage of that avoidance of capital gains tax, regardless of whether or not the clients are itemizing in that particular year, regardless of whether or not they can use that charitable tax deduction. So we're going to start with that very basic concept that as a matter of charitable financial planning, we would much prefer our clients to give appreciated assets rather than giving cash. And then we're going to spend lots of time talking about all the different creative ways that we can leverage that. Well, just as an example, let me put some numbers to that to show how this works. And here, I'm just going to use the federal taxes. Obviously, state taxes will make this even more extreme. But if somebody writes a $100,000 check to a nonprofit organization, they get an income tax deduction of $100,000. Now, in the best case scenario, at the federal levels, that $100,000 deduction can be used for 37 cents on the dollar, top tax rate of 37%. So that reduces the cost of their gift by $37,000. So in other words, it's kind of the way that we can get the government to match their charitable giving to make it more powerful. So that $100,000 gift actually only costs $63,000. But let's suppose instead of writing a $100,000 check, we gave $100,000 of stocks. Let's say these are stocks we bought for $10 a share. They're now worth $100 a share. Well, we're avoiding paying all of that capital gain tax. And so that tax avoidance, that avoids another $21,240 worth of taxation. So the net cost of that gift drops down to $41,760 as compared with giving cash or as compared with selling the asset and using the cash in other ways. Now, of course, this becomes even more powerful for those who are not itemizing. If you can't use the deduction, and of course, with a deduction of this size, you could use it. But the point is, if you can't use the tax deduction, you can still use the capital gains tax avoidance. Now, this kind of strategy actually gets more powerful if you're in a state that charges state capital gains tax. So the higher the rate that the state might charge for capital gains tax, the more powerful it is for clients to avoid those state capital gains tax. And this is actually more so the case since 2018, because many of your clients are going to be capped out from being able to deduct their state and local taxes that they pay. And so that makes avoiding those taxes at the margin so much more powerful than it was before the 2018 tax law. So because those state taxes, in particular those state capital gains taxes, are more painful, avoiding those with smart charitable planning is more powerful. So this is something to keep in mind, that we want to pay attention to state taxes even more than we might have before 2017. Now, the very most basic concept that we want to start with in charitable giving is what I like to call the charitable swap. So oftentimes the scenario will come up this way. Let's say we've got a client who's getting ready to write a $100,000 check to charity. And we say, okay, that's great, but before you do that, do you want to consider giving some appreciated assets? You know, I know you've got, I notice you've got some shares of Apple stock you've held for a long time. Maybe you want to give those shares of Apple stock rather than to write the check. And the client says, well, yeah, I understand that's a good idea, but I really want to hang on to those shares of Apple stock. You know, I'm not ready to sell them. Well, actually, the client doesn't have to change their portfolio at all. They simply take the old shares of Apple stock and they give those old shares to the charity. They take the cash that they were going to have given to the charity, and they instead use that cash to immediately purchase brand new shares of Apple stock. Now, notice the portfolio doesn't change at all. They own the exact same number of shares before they made the transaction as they did after. The only difference is before they owned the old shares of Apple stock that had a very low cost basis. And so consequently, those shares had a lot of capital gain accumulated in them. Now, at the end of this process, we have the same number of shares of Apple stock. The portfolio hasn't changed at all, but the capital gain has all been wiped out. So the idea is if you've got a client with marketable public securities that are appreciated, if that client is giving cash to charities, we actually want to shift that as much as we can and say, no, don't give the cash, give the appreciated securities, and we'll use that cash to buy identical replacement shares. Now, when I said that you can do this in the same day, at the same moment, some of you may have hesitated a little bit because you're familiar with the wash sale rule. Notice that the wash sale rule, which would require a delay before we repurchase shares in the same company, does not apply here. The wash sale rule is for lost property, and we're not donating lost property. In fact, you never should donate lost property. If we've got property that's gone down in value, what we want to do is we want to sell that property, take that valuable tax loss, and then we can just give the cash to the charity. So because we are only using appreciated assets here, not lost property, this is gain property, there is no wash sale rule that applies to this transaction, which means we can do it at the same moment, we can do it at the same time. Now, of course, whenever we're making these kinds of transactions, one of the great things to do is to use a donor-advised fund, whether that be a donor-advised fund through the Central New York Community Foundation or others. These kinds of funds make it so much more flexible for clients so that, again, it's the same charitable swap, it's the same transaction. We give the old shares to the charity. In this case, the charity is the donor-advised fund. We use the cash that the client was going to have donated to purchase brand new identical shares. Now, one of the things that I want to keep in mind about this process is that we can use this process as a way to not only get rid of the capital gain, but in some ways to have a way that we can lock in some of the gains without changing the portfolio. What do I mean by that? Well, let's say you have some shares of stock you bought for $10 a share. Now they're worth $110 a share. And let's say 2 years from now, they're going to go back down and only be worth $10 a share. Okay. If you don't do any of these transactions, you get no benefit from it. You bought it for $10 a share. 2 years from now, it's going to fall back down to $10 a share. But notice, if I, in the meantime, when it was high up at this $110 a share, if I replace some of my cash giving with giving that appreciated asset, again, same transaction as here, I donate the old shares that are now worth $110 a share. I can get that tax deduction for that full value. I then buy brand new shares with the cash that have a basis of $110 a share. Now, notice what's happened. 2 years from now, it drops back down to $10 a share. But because I did this transaction when it was high, I've got a very valuable tax loss that I can claim when I sell those shares of stock for $10 a share that I wouldn't have otherwise. Also, another, of course, very popular strategy that we want to use with donor-advised funds is to bunch our gifts into a big giving year and then have other years where we're not using the charitable deductions, where we're just using the standard deductions. When we're doing that bunching with the donor advised fund, picking out that big transfer year for the donor, again, it's better to give appreciated assets rather than simply to give cash. Now, again, the idea of how this works is that we get the tax deduction when we move the asset into the donor advised fund. There's no additional deduction that happens when that fund pays out cash to various charitable organizations over the following years. So the idea being, let's pick a year where we're definitely going to itemize. We're definitely targeting that year as our year to use the tax deduction. We shift all of the assets that we want to use for the next 3 or 4 or 5 years worth of charitable giving into the donor advised fund in that target year, take that massive tax deduction in that year. And then in future years, we just take the standard deduction. We won't be generating additional charitable deductions by making those transfers out of the donor advised fund, but we don't need those because we're taking the standard deduction in those other years. So these gifts of assets work very well with donor advised funds. And one of the great strategies to use is the charitable swap. Now, when we're looking at some research on who actually makes these charitable gifts, aside from having the appreciated assets, the most powerful predictors from a national study using data from the Consumer Expenditure Survey from the Bureau of Labor Statistics, the top 3 predictors were having high income, high education, and being age 65 or above. So these types of gifts are particularly attractive for folks who have reached retirement age, oftentimes having those appreciated assets, and many times not having a high amount of income that is reported relative to their assets that they have. Do keep in mind, people were just as likely to make these gifts, regardless of other demographic factors, gender, race, ethnicity, marital status. None of that predicted this. It was really just about, aside from having the assets, high income, high education, and being age 65 and above. So do keep that in mind for folks that are interested. So let's talk a little bit about what's motivational to clients. Now, of course, the motivation for giving has to do all about philanthropic impact, but a donation doesn't result simply from motivation for a philanthropic impact. It results from the intersection of motivation and cost. And so tax benefits, tax deductions are very powerful. They are very influential. And it turns out that nationally representative research shows that they are more influential for some types of giving as opposed to other types of giving. So for example, we've got a long history of research that shows that, giving to certain causes is more responsive to tax benefits than giving to other causes. So for example, giving cash to educational institutions, that was twice as responsive to changes in tax price as compared with giving cash to religion. So giving cash to religion tends to be not that tax price responsive. Actually, giving to arts tends to be the most responsive to tax price. However, notice this: giving stocks, bonds, and mutual funds to any charity was 10 times more responsive to tax price than giving cash to education. So what that means is it's always a good idea to mention the tax benefits, but when it comes to gifts of stocks, bonds, and mutual funds, it's 10 times or 20 times more influential to focus on these tax benefits. Now, this comes up with another important question, which is, how should we talk about these gifts of assets? In other words, what sort of language should we use? What is most influential for clients? And oftentimes this question comes up in charitable planning. It's the question of, should you mention tax benefits? Now, Look, I know a lot of people who are on this call. This is an obvious answer. Of course, you should mention tax benefits. We're in tax planning, but I got to tell you, there's a lot of bad advice, a lot of bad information floating around out there. And let me explain the source of this bad information. So here's what happens. You'll have a consulting company working with nonprofits that decides, hey, we want to learn something about why people give. So they'll send out a survey and they'll ask people who are donors, why do you give to charitable causes? And they'll have a bunch of different options. You know, I give because that's the way I was brought up. I give because of my values. I give because I want to make an impact on the world. And then they'll have one of the choices, I give because I want tax benefits. And they'll get back all of these surveys and they'll say, nobody says they are giving because of tax benefits. Therefore, you shouldn't talk to people about tax benefits in charitable giving. As a researcher, this drives me up the wall. This is not the appropriate way to interpret those results. There's two reasons why. Number one, even if this were the motivation to give, we couldn't discover it this way, okay? People will report socially approved motivations when we ask them for their motivations for actions. However, other motivations have to be tested, not self-reported. Beyond that, as I mentioned before, giving does not come simply from philanthropic motivation. It comes from the intersection of motivation and cost. So regardless of whether or not, even if you believe that tax benefits aren't a motivation, they don't have to be, because giving comes from the intersection of motivation and cost, and being tax smart with your giving is certainly can certainly affect the cost. Now, when I say that other motivations must be tested and not self-reported, what are some examples of how we can do that? Well, certainly the previous results that I showed you actually come from nationally representative studies, and we can see how people respond to tax benefits, not only when there's changes in legislation, but actually we can see that because people's tax benefits change at every single level as their tax rates go up. So we can see how those changes in tax rates, which of course impact how valuable the tax deductions are, will then ultimately impact their charitable giving. But here's another way you can do it. In this study, we had over 1,000 folks, and we just randomly assigned them to one of two descriptions of a gift. Some folks were asked about their interest now in making a gift of stocks or bonds to charity. Other folks were asked about their interest now in avoiding capital gains tax by making a gift of stocks or bonds to charity. And notice, people are more interested now in making a gift that is avoiding taxes by making that gift. So then in another study with more folks, about twice as many folks, we decided to split this three different ways. We randomly assigned people to one of three groups, and in this case, describing a charitable gift annuity. We used the same line to describe the gift annuity, make a gift that pays you income for life. The only difference was one group got just the description, one group got the description with the reference to the tax benefit at the end, and one group got a description with the reference to the tax benefit pulled all the way to the beginning. And notice the difference in the share of folks who are interested now in that gift. It goes up when we reference the tax benefit at the end, and it goes up even more when we actually lead with the tax benefit. Now, I mentioned that this group was randomly assigned to these three descriptions, but just to make sure we didn't get lucky, we then rotated the group so that the group that had been on the top in the last slide was now on the bottom and vice versa. And now we gave them a description of a remainder interest deed or a retained life estate deed. We'll talk more about this instrument, so if you're not familiar with it yet, we'll get into that in just a few moments. But notice the same setup, identical description, no reference to the tax benefit, adding the reference to the end and bringing the reference to the beginning. And notice how this really increases the share of folks who say they're interested now in this kind of a gift. Well, just to spin the wheel one last time, we went ahead and rotated the groups again, now with the description of a charitable remainder trust, and one with no reference to the tax benefit, one with the tax benefit reference brought almost all the way to the front, and then all the way to the front. And you notice the same basic scenario, that as we reference the tax benefit, even lead with the tax benefit, we get a higher level of interest. So it is certainly okay to talk about tax benefits when it comes to philanthropic giving. We can talk about how to give smarter. By the way, are there any magic phrases when it comes to describing tax benefits? Well, in this study, what we did was we asked folks to, if they were visiting their favorite charity's website and they happened to see a button with a particular title on it to tell us to rate their level of interest, and clicking on that button to read more information about it, okay? And this was the share of folks who said that they were interested, either definitely or they might be interested in reading more. So notice there wasn't necessarily a magic phrase as long as we did reference the tax benefits in describing the information. The worst performing phrase was just click on giving stocks. Turns out people don't really want to read more about giving stocks, but they definitely do want to read more about avoiding taxes by giving stocks. Now, although there was no magic phrase, I will say that there was a bit of an improvement if we shifted from talking about avoiding capital gains taxes by giving stocks to simply avoid taxes by giving stocks. And by the way, in all of the language testing research that we've done, this actually is a very common principle. Whenever in a space of philanthropic giving, whenever we can use more simple language, simple words to describe the concepts, we actually get more interest from clients in learning more about those concepts or in actually even making those transactions, making those gifts. So simple language and stories tend to always outperform whenever we use our complex insider language. And this is just one example of that, but it's a principle we see again and again in research. One of the things that's very powerful to keep in mind from the nonprofit perspective, but also from the donor perspective, is that for nonprofits, accepting non-cash gifts is so much safer today than, say, 20 years ago. So why is that? Well, certainly if the nonprofit wants to directly accept those gifts, there are new instruments like the single asset LLC that are available for nonprofit organizations that weren't available before. But beyond that, if you're working with a nonprofit or for a nonprofit, if there's a donor who wants to transfer something valuable to the charity, the answer is never no. The answer may simply be, absolutely, we love that gift. We just need to run that through a donor advised fund. I'll show you how to walk through that process. So the point is that if, let's say you're representing the client and the client wants to give to an unsophisticated charity, maybe it's their local synagogue or church or mosque. And when you start talking about, making even a transfer of securities, oh my goodness, what is that process? We've got to do medallioning and all of that. I don't, they're not going to be sophisticated enough to deal with the asset. It's not a problem. We just work with the donor advised fund, start with the Central New York Community Foundation. They will give you guidance on how to work with that. And frankly, if it's an asset that's too weird for the community foundation, there are other donor advised funds that are established and basically exist just for the purpose of taking weird assets. As long as it's something that's a valuable asset, we're talking anything from a partial interest in a racehorse to unharvested crops. In one case, even an elephant ride business in India that had to be held for 3 years before it was sold. I mean, anything valuable. Now, don't bring me your timeshares. You know what I mean when I say anything valuable. But the point is, anything valuable we can work with now. And so the answer is never no. Do keep that in mind. Now, of course, you're probably already familiar with that required minimum distributions are back for 2021. We didn't have them last year. We do have them this year. Now, one of the things to keep in mind, as you probably know, is that if you've got a client age 72 or older who has a required minimum distribution, you can make charitable transfers directly from that IRA or IRA rollover to make those transfers to the charity, and it counts against the required minimum distribution. However, there's a couple of important things to keep in mind about that. Number one, the limit for making charitable gifts this way has nothing to do with the required minimum distribution. The limit is $100,000 per person. So that's particularly important if you've got somebody, let's say age 70 and a half or older. They can make these gifts even though they haven't hit required minimum distributions yet. Now you compare the tax benefits of making a gift from that money that's going to be taxed whenever it's pulled out. So we've got money that they've earned, but they've never paid taxes on. If we make a gift from those assets, now they never have to pay taxes on it. You compare that to simply writing a check, especially if you've got a client who's not itemizing, so they get zero tax benefits from that kind of a check. These kinds of gifts can be very powerful even without required minimum distributions or even beyond required minimum distributions. So again, regardless of the RMD, the limit for these gifts is $100,000. If you're age 71 and you've got no RMDs, the limit is $100,000. If you're 74 and your RMD is $200,000, the limit is still $100,000. These things are not related. One other trap to keep in mind. These are available, of course, only for IRAs or IRA rollovers. So if you've got a client with assets in a different kind of traditional retirement plan, 401k, 403b, et cetera, you first got to roll these over into an IRA rollover before you can make these direct distributions to the charity. However, be wary of this. You actually want to make that rollover back when they're, say, age 70 and a half. And the reason why is this. If you wait until they hit the year in which they're going to turn 72, in other words, if you wait until they have RMDs, you're not going to be able to get out of those RMDs for that year, because in the year that you convert that account into an IRA rollover, that conversion requires that you first pay out the RMDs for that year. So you actually want to make this account conversion before the year in which the client's going to have their required minimum distributions. Otherwise, you can't get out of that first year of required minimum distributions. So it's really a good idea to start talking to people about qualified charitable distributions when they hit age 70, because that's when they're coming up on the point when they can actually start using these. They can start using these before required minimum distributions, and they're at the point where if they think they might be using them because they're making charitable gifts and expect to continue to do so, we need to roll over those accounts now, sooner rather than later, in order to avoid those required minimum distributions. Well, since we're talking about some of these tax wonky approaches to these kinds of QCDs, let me give you one of the wonkiest approaches. So this is something a little bit weird. You may not have a client who's in this exact situation, but one of the things to keep in mind that the Secure Act opened up the possibility for is this. Now, with the Secure Act, we got a change in the law that allowed folks to continue making deductible contributions to an IRA at any age. So we can have a much older client. They might be 72, they might be 73. They can still be making these deductible contributions, right? Now, we can't combine folks who are making those deductible contributions at those older ages in the 70s. They can't be making those deductible contributions and then pulling that money out through a qualified charitable distribution. Because if the person does that, that's essentially an above the line charitable deduction. So they said the same person can't do that. But if you've got two people in the household, you can actually have one person that's making those deductible contributions to the IRA and the other person who's making those qualified charitable distributions to the charity. So their combined accounts, the amount doesn't change. So if you've got a client who says, yeah, I could be making contributions to my IRA, but I don't really want to be increasing the amount that's in my IRA right now. If that client, say, is a married couple or any couple that's sharing financial resources, is making charitable gifts, we can actually split this up and say, okay, this one, say, spouse or partner is going to be our QCD donating partner. And this earned income partner is going to be our contributing to the IRA partner. And so you can actually get something that has a bit of the flavor of an above the line charitable deduction, where you're not really changing the IRA balances at all combined, but you are getting that deduction for sending money into one IRA, even though you're taking money out of another IRA. So getting a little bit wonky there, but that is a possibility. One of the most powerful things we can do in charitable estate planning, and one of the very first things we want to do in charitable estate planning, is to name the charity as the beneficiary on any qualified plan money. And the reason why is that retirement plan assets that are inherited by non-charitable beneficiaries, so any family members, anybody else, are going to be reduced by income taxes. A lot of people miss this because they think, oh, well, my estate's not at whatever that is, that 11 million or even $22 million level. I don't need to worry about estate taxes. Well, okay, but you actually do need to worry about income taxes. Let's look at an example to illustrate the point. Let's suppose we've got a client who's only got two assets. They've got $1 million traditional IRA and $1 million house. They say, I think I want to do a 50-50 split between, let's say, my church and my child, or whatever the charitable cause is, and my child. Does it matter which goes where? Well, it matters a lot. Now, notice this client only has $2 million in assets. We don't care about estate or gift taxes for this client, right? But notice how taxes can make a massive impact. Let's suppose we do it wrong and we say, well, I'm going to go ahead and give the house to the charity, and I'm going to leave the IRA to the child. So the beneficiary designation on the IRA goes to the child, and the house designation goes to the charity. So what happens? Well, the charity gets the $1 million house. They're happy because it's worth $1 million to the charity. The child gets the $1 million IRA. But let's suppose that child is paying taxes at the top federal rate. And let's make it more unfortunate and stick them in California, where they're also going to be paying the top tax rates for the state of California. Notice what happens is that $1 million IRA becomes a $497,000 value to the child, because they got to pay all those income taxes on it when they pull it out. And of course, now with the Secure Act, that child is going to be required to pull that out even faster. They're going to have to pull all of that out within 10 years, regardless of whether they need the money yet or not. Now let's flip that around and let's do that the right way. The right way is we leave the IRA to the charity. The charity is just as happy to get that IRA. It's $1 million IRA. It's worth $1 million to the charity. Of course, the charity is an exempt organization. It does not pay taxes on that income. And so the $1 million is not reduced at all. We instead leave the $1 million house to the child. And what is their income tax? No income tax at all. And so we have $1 million to the child. At least no income tax as long as we have the stepped up basis, and also no capital gains tax in that case. By the way, I should have mentioned, when we're talking about, let me bounce back here a little bit. When we're talking about this idea of the doing the charitable swap, sometimes there's a pushback from this that says, yeah, that's a good idea, but my client's not planning to sell ever, right? And so consequently, since they're not planning to sell ever, I don't even care what their basis is in their securities. Well, there's two problems with that. Number one, you don't know if they're going to need to sell that asset or not. Things happen where maybe they are going to need to sell it. So why not get rid of the basis? And now we've got a new reason to sell, because of the legislative instability of the stepped up basis at death. We don't know what the law is going to be when they die, whether we're still going to have stepped up basis at death or not. So consequently, we need to be more diligent at wiping out that capital gain from the portfolio. So retirement plan charitable beneficiaries. If you are going to add that charitable beneficiary onto the retirement account designation, it's great to use a public charity, certainly can use a donor advised fund, a private family foundation, even that works. You can even name a charitable remainder trust as a charitable beneficiary. And in fact, we'll talk about charitable remainder trust here in just a moment, but charitable remainder trust as a beneficiary can actually create a way that you can stretch out those payments to a child even beyond the 10 years. However, there are some things we want to avoid when we're naming the beneficiary in that IRA or other type of qualified plan account. Do not name a charitable lead trust. We'll talk about what those are in just a moment, because those are not tax exempt entities. And be very careful, not saying it's impossible, but be very careful about naming the estate as the beneficiary with instructions in the estate documents themselves. This can be done, but you better make sure you have sophisticated estate planning counsel to do this in the right way. Because if you don't get the language just the right way, what's going to happen is the estate itself is going to get that IRA money. All of that cash is going to be considered income in respect of a decedent, and the estate is going to have to pay all of those income taxes on that IRA. So just a warning there, not saying it's impossible, but it's very tricky to make sure you get that language just the right way so that you don't trigger that income in respect of a decedent treatment where the estate is having to pay those income taxes.
Hey,
Now,
I can just chime in for a second,
Yeah,
Dr.
please.
James.
Yeah.
So one of the great things about the way we do legacy planning at the Community Foundation is that for the charitable parts of a person's estate plan, they can just send, that, whatever it is, the residual, $1 million, whatever the gift is, point it to the Community Foundation, and then we can create a legacy plan that does all the things, charitable remainder trusts inside it, funds that, they're donor advised funds for their children, permanent funds that support the organizations that were important to them. So there's a lot of flexibility there. And then anytime they want to change that plan, they don't have to reopen their estate documents. So it's really straightforward, cost effective, and gives them the flexibility of working with charitable planners on the charitable part. So.
Well, that's a really fantastic option. Now, I don't mention that because not everybody is lucky enough to live in a community that has a community foundation that is flexible enough to do that sort of thing. But certainly having that option is a wonderful strategy. And that's particularly powerful when it comes to things like these beneficiary designations, because of course on the designation itself, you can't put much in the way of instructions, right? It's just got to be who it goes to. So if you want to do instructions, that's a great strategy to be able to send it to the community foundation, but the donor's already established the ways in which those funds are going to be used there. So great idea, great idea. One of the things I do want to mention, because from time to time, you'll get folks that get a little bit of information, but they don't really understand that information, and they sometimes give bad advice to clients, and that is this. So the concern, not really a concern, I'll explain why in a moment, but the concern is this: charities are not designated beneficiaries. So there's a risk or there's the appearance of a risk that this could accelerate the required minimum distributions for the other beneficiaries. However, this is a problem that has so many solutions, it's difficult to even call it a problem. So what do I mean by that? Well, let's start really simple. As long as you pay out the charity their share by the September 30th of the year following the year of the participant's death, this doesn't apply, right? I have never met a charity that, having been named on an IRA, responds to that by saying, oh no, I just want to leave the money in that IRA. We don't want to take it out and use it, right? Doesn't exist. Charitable organizations want that money to come out. There's no reason not to pay out the charitable organization, as long as you pay out the charitable organization, again, by September 30th of the year following the year of participant's death, not a problem. Look, there's other solutions. The beneficiaries could simply separate the accounts into charitable and non-charitable accounts by the end of the year before participant's death. That works as well. If you want to, you could get really specific and you could separate accounts during life between a charitable and a non-charitable one, so that you could be very specific on which one you're pulling your RMDs from. Obviously, we don't even worry about this if the beneficiary is going to be a spouse, because the spouse can simply roll his or her share over into the spouse's IRA. So again, not a problem that way. Anyway, long way of saying there's so many different, very simple ways, such as, hey, let's just pay the charity their share. Simple ways to avoid this. It's not a concern. It's not something that should make you hesitant about naming a charitable organization as a beneficiary on these accounts. So let's talk about some other instruments here. Some you may or may not be familiar with. One is a charitable gift annuity. So what is a charitable gift annuity? Well, this is pretty straightforward. A charitable gift annuity is when a donor makes a gift to a charity and they get back lifetime income. It can be income for 1 or 2 lives, and that's a fixed payment amount, and it continues all the way until the end of life. Of course, as with any annuity, the payments that the the annuitant receives are going to vary based upon age. And so these are the current rates that American Council on Gift Annuities suggests based upon age. And again, these are not interest rates. These are payment amount rates, not interest rates, because as with any annuity, any standard annuity, it is just a payment for life. And then whatever's left over at the end of life, in this case, goes to the charitable organization. So this would be for a charitably inclined client who perhaps wants to leave something at the end of life to a charity, but they also want income that won't change or run out. Now, that can be really important because actually a charitable gift annuity is backed by all of the assets of the nonprofit organization. So if you're talking about very large or stable charitable institutions, sometimes people are just tired of all the market volatility, and so they will shift to the charitable gift annuity just to get that fixed payment. And we actually did see during the financial crisis, we did see the use of large charitable gift annuities went up as people were just tired of the market volatility. So let me tell you a little bit about the taxation of these charitable gift annuities and how our current environment is impacting them. So keep in mind the idea is this. When a donor makes that gift, they get a charitable deduction for part of the gift that they make. This is simply it's a form of a bargain sale. A donor gives cash or other property to the charity and gets back an annuity that's worth less than that cash or other property that they gave. So what the donor gets back is they get back these payments each year, month, quarter, however they set them up for the rest of their life. Now, the treatment of those payments can be ordinary income, it can be tax-free return of investment, or it can be capital gain. We've also got some gift tax issues if instead of choosing themselves as the person who receives the payments, if they say choose a child or someone else to receive those payments. So very simple, the way these work is that the charitable deduction is the value of what you give less the value of what you get back. So let's say a donor gives $100,000 of cash. You take that $100,000 of cash, you then subtract the value of the annuity that they got back, and you get your charitable deduction. So that's the very straightforward way of how it works. Now, as the interest rates fall, the value of that fixed annuity goes up. So the deduction amount is falling as annual annuity value is increasing. Now that's bad if you want to use the deduction, but it's good if you're not using the deduction because it changes the tax treatment of each payment. And of course, you know, we've been through a scenario here where rates, if we went back a year ago, rates were much higher than they are now. We bottomed out at about 0.4%, and now we're back up to the 1% rate. So this can affect the deduction as the rates at their very bottom, the deduction for making that gift would be lower. Now that deduction is going to be higher. So here's the thing that's a little bit unusual with the charitable gift annuity, and that is it connects in with this 100% limitation on being able to wipe out all of our income in 2021 with charitable deductions. If it's funded with cash, the income tax deduction should be able to eliminate 100% of income in 2021. I'm going to walk through the language to explain a little bit about how that works. So we've got two ways that the gift annuity can benefit the client. One, because it creates a tax deduction. And if it's funded with cash, we can use that tax deduction up to 100% this year. But the other way is, let's say we've got a client who's not using the tax deductions. They're not itemizing at all. If a donor can't use the charitable tax deduction, the lower interest rates are better because a larger share of each of their payments is going to be considered tax-free return of their original investment. And so it actually helps clients who are not using the charitable deduction to be in the low interest rate environment. So let's jump into the language as to why a charitable gift annuity funded with cash will qualify for that 100% limitation. So what is a qualified contribution? Well, first, if the client wants to use the 100% income limitation, they've got to elect that treatment for the gift. Also, the gift can't go to a normal donor advised fund or a supporting organization. Finally, that qualified contribution requires, and here's the key language, such contribution is paid in cash during calendar year 2020. Now, of course, that was extended to 2021 to an organization described in section 171B1A. So let's break it down. Qualified contribution is a deductible contribution, number one, that's paid in cash, number two, during the year, and number three, that goes to one of these public charities. So here's the thing to keep in mind that's really important to know about a charitable gift annuity, why it's different. In a charitable gift annuity, it's just a trade. It's a form of a bargain sale. It's like if I pay a charity $1,000 to attend a fancy dinner, and that dinner's, the ticket to that dinner has a market value of, let's say, $95, okay? That's the same kind of transaction. I've given them cash. They've given me back something else that's valuable, but not quite as valuable as what I gave them. That's how a charitable gift annuity transaction works. I give them cash. They give me back something that's not quite as valuable as what I gave them. However, the key idea here, and I'll explain more about this in a moment, is that this is not a split interest gift. I retain no rights at all in the cash or property that I give to that charity in exchange for the charitable gift annuity. It's a trade. I'm not giving them something and keeping some interest in that. I'm giving them something and they're giving me back something else that's not worth quite as much. So in the same way that if I write $1,000 check to a charity, they give me a ticket to a banquet that's worth $100, that $900 deduction should qualify for this 100% income limitation. In that same way, the cash gift that funds a charitable gift annuity should also qualify. Now, again, if you've got a client that's not using tax deductions at all, then we actually have a benefit in that a larger share of each of the annual payments will be considered tax-free return of the original investment because of the lower interest rates. So again, the idea here is that part of each annuity check just gives you back some of the money that you paid, and the rest is taxable. So that part that is not taxable is much larger when interest rates are lower. There's no tax on getting back your own money. So the way we calculate this is we look at the dollars used to buy the annuity divided by the original life expectancy. That share of the dollars used to buy the annuity, as interest rates go down, that dollar amount goes up, which makes a larger share of each payment return of original investment. So let's talk a little bit, not so much about the tax implications, but a little bit about how we have conversations on this. And this is a series of tests that were published that dealt with charitable gift annuities, but they actually deal with any kind of a complex charitable financial transaction that we might discuss with clients. So we started out trying to test different messages. And again, the particular charitable instrument we're using here is charitable gift annuities, but you could do the same kind of a test for any kind of complex charitable instrument. So first, what we did is we split people, randomly assigned them to one of two groups. those two groups got a description of a gift annuity. This was an example of what they saw on the screen, what you see in each of those boxes. And then they were asked to please rate your interest in pursuing the above described charitable giving arrangement. Now, the only difference between those two descriptions was that one description talked about what you could do. You make a gift and receive a tax deduction, etc. The other one talked about what Sarah had done. Sarah made a gift and received a tax deduction, etc. Okay. We asked people about their interest in pursuing that charitable giving arrangement, and notice people were more likely to want to pursue that charitable giving arrangement if they had read about what Sarah had done, rather than if they had simply read about what they could do. So sharing a story about someone else was a very powerful way to communicate the concept about this complex charitable giving instrument. So then we decided to show them a picture of Sarah. So again, we're using identical language here. Some people saw the information on the left, which was just the text. Some people saw that same text with the image on the right. And the results got worse when we showed them a picture of the donor. So that led to the question of what's going wrong here. What's the problem with the donor picture? Is it just this photo? Is it the donor's age? Is it photos in general? Or what's causing the problem? So, of course, being a researcher, we want to test a bunch more Sarahs. So here's again identical language, and we've got a whole host of Sarahs, and we again ask people their interest now in pursuing this charitable giving arrangement. And what I'm going to do here is I'm going to put a box around the best performing Sarah based upon the age of the person answering the question. So notice what we see here. We see that there is this relationship where if we are age matching the image of the person next to the description of the complex charitable giving arrangement, we get a higher interest from that version that age matches. If we're not age matching, and we're looking at someone who's a very different age group from the person that is answering the question, the interest is not as high at all. We then decided to see, okay, how do these compare with text only or a non-donor photo? And for the non-donor photo, we just used a campus shot image, which is the one that you see here on the screen. The results were this. Similar age donor photos did better than text only or non-donor photos, whereas dissimilar age donor photos did worse than text only or non-donor photos. Now, what's more important in this is not just the concept of age matching. The concept that is valuable is to understand why this age matching was powerful. So statistically, we went in and analyzed their various responses and found that this age matching effect, it actually was completely explained by their answer to one question. The statistical term, it was fully mediated by the answer to this one question. And the one question was this: how much do you identify with Sarah? From she is not at all like me, to she is somewhat like me, or she is a lot like me. To the extent that the person felt like Sarah was more like them, they were more interested in this complex charitable giving arrangement. To the extent that they felt that Sarah was not at all like them, well, they were not interested in this particular complex charitable planning instrument. So the underlying idea here is this: it's not really just about age matching. It's that one of the most powerful messages that we can send to a client is this underlying concept that people like me do things like this. So if we're sharing a story about what someone else has done, if we take a moment to mention some way in which that person is similar to the person we're talking to, maybe they've support similar charitable causes, maybe they're in a similar financial situation, or whatever the kind of similarity we want to point out, that's going to make that example so much more powerful. So identifying with the example person that we are talking about, that makes these kinds of communications more powerful. Okay, so let's start getting a little more wonky. We started out with the straightforward stuff of giving appreciated assets. We talked about charitable swaps. We talked about qualified charitable distributions from an IRA. We talked about leaving IRA and other qualified plan money to a charity through a beneficiary designation. Let's start having more fun with all of the interesting things we can do. And we begin with the non-grantor charitable lead trust. What is this animal? Well, this animal works this way. A donor takes an asset or cash, whatever they want to take, they put it into the trust basket. That trust will then pay out every year to charity for a fixed number of years. Anything left over at the end goes to the donor's heirs or whatever family members they've selected. That's how the instrument works. Why in the world do we want to use this sort of thing? Well, let's be real straightforward. We use this sort of thing for one purpose, and that is to cut gift and estate taxes. Okay, so let's talk about how this can be a very powerful instrument to cut gift and estate taxes and why it's super powerful right now. So here's the way it works. When the client puts their assets into their charitable lead trust, they at that point pay gift taxes on the present value of the projected amount that's going to go to their heirs or other family members or whoever they select. Here's the important part. No gift or estate taxes are paid on the actual amount that eventually goes to the heirs. Okay, so that creates a planning opportunity. If the actual amount left over at the end for the family members is higher than the projected amount, all of that extra growth goes to the heirs 100% tax-free. Now, here's why this is so powerful to set up right now. The projected remainder amount on which we have to pay gift taxes assumes that for the life of that charitable lead trust, it's going to have returns at the initial Section 7520 rate. That means if you set one of these up before the end of the year, when we can still use the 1% rate that we're under right now, that means you can set up a trust for 10 or 20 years under the assumption that it's only going to grow at 1% for all 20 years. And any growth above that 1% amount, that goes to the heirs completely tax-free. So that's the advantage we're trying to take advantage of. Now, let me explain a little bit about how this might work. So let's use the lowest interest rate to look at the most extreme example. Let's suppose you've got a client that puts $10 million into one of these charitable lead trusts back when the rates were 0.4%. If that trust is scheduled to make annual payments of $521,000 a year to charity every year for the next 20 years, what is the projected remainder that's going to go to the heirs? $0. What do we pay gift taxes on right now today when we make that transfer into the charitable lead trust basket? $0. So there is no tax cost in estate and gift taxes to make this transfer because the projected amount is $0. Now, if the actual growth is not that low Section 7520 interest rate, but it's the 8% growth rate, then the actual remainder will be about $23 million. Now, under current rates, the actual remainder is going to be about $22 million, and you pay about $540,000 a year to charity. The point is, we're still in a low interest rate environment, so this can be a very powerful strategy to basically ship all of that growth out of the estate for a client who's planning to be making these charitable gifts anyway. Now, this may end up being more powerful because some of the other strategies that we have, GRATs and various other things like that, may not be able to use them much longer, depending upon what the new legislation looks like. So do keep in mind this strategy. I also want to point out that this is a very powerful estate planning strategy to put into the estate planning documents. So look, if a charitable gift was already planned, the zeroed out CLAT provides a no-cost chance at tax-free transfers to family members. So if we go back to this example here, if you've got a client that's already making gifts to charity of this amount, well then, what's the risk, right? If you outperform that 1%, all of that goes tax-free. If you don't outperform that 1%, no worries, you were planning to make those charitable gifts anyway. This is also the case if you've got a client who was planning to make that charitable bequest. So if they're planning to make a charitable estate gift, the zeroed out CLAT can be a very powerful strategy as well. There's a couple of reasons for this. So let's say we're doing this exact same transaction, but now we're doing it in an estate plan. So at the client's death, that's when the $10 million gets shifted into that trust basket. Okay. Well, if the client was already planning to say, hey, I'm going to leave, say this $10 million, I'm going to leave that to charity in my estate anyway. And again, we can do this with any charity. So it can be a donor advice fund, private family foundation, whatever it might be. If the client's already leaving that money to charity, we can leverage that by saying, well, let's not leave it directly. Let's leave it through this charitable lead trust so that we can actually transfer more of this money to the heirs in a tax-free setting. I've got to tell you, there's another reason why this is really effective estate planning, and it has nothing to do with taxes. It has to do with when the heirs are going to get the money. If you can create an estate plan that gives the heirs more than one shot at their inheritance by breaking up the times during which they're going to get that inheritance, that can be really powerful for being able to preserve that wealth. And there's some psychological reasons for that. When we actually look at national statistics, the typical inheritance has been completely eliminated within 18 months of receiving that from the heirs. There is a psychological factor that underlies that. Let's suppose you have a parent who passes away, my mom dies, and then I get a sack of money that is my mom death money. There is a psychological resistance to that death associated money, and people will tend to engage in one of two approaches. In the psychological literature, this is called avoidance or symbolic immortality. Avoidance is, what do I want to do with this mom death money? Well, it makes me uncomfortable every time I interact with it. I actually want to get rid of it. And that's typically what people do. The other strategy is to say, this is not my money, it should be permanent. And that's this pursuit of symbolic immortality, where we completely set it aside and we treat it not as my money, but as family money, and then it can last indefinitely. I'm just saying that literally the worst possible time to transfer money to an heir is at the death of a loved one. So if we can use techniques that will give them money that's broken out, where they're receiving that money 5 or 10 or 15 or 20 years later in different parts, it's going to lead to much more wise use of those financial assets. And that has to do with some of the underlying psychology. So by the way, keep in mind, and again, getting a little bit tax wonky here, but if you do set up one of these charitable lead trusts, that charitable lead trust is not a charitable entity, but it can deduct any of the payments that it makes to charity. Now notice, this actually creates an income tax planning opportunity. What do I mean by that? Let's suppose you have a very charitable client who's making gifts to charity and plans to continue to do so for many years, but let's say they've made those gifts out of their very substantial wealth, but they've got relatively little reportable income, so they're already capped out. Especially after this year when the 100% income limitation is going to go away. let's say they can't use the deductions because they've already donated too much, right? And yes, we can carry those deductions over for an additional 5 years, but maybe you've got a client who's given out of their wealth, their reportable income is so low that they simply can't use those deductions, okay? Because they're capped out, and even the carryover they're not going to be able to use. Notice, here's a way that we can actually take advantage of the deductions, because we can take that income producing asset, we can put it over into this charitable lead trust instrument, and that charitable lead trust, which is its own taxpayer, it can deduct 100% of all of its charitable gifts off of offsetting all of its income. And in fact, you can go ahead and you could draft the charitable lead trust in a way that it not only pays out the fixed amount, but it can pay out any additional income as well, if the client wants to see that happen. So it's just a way where now the client is able to avoid recognizing the income on that income producing asset by shifting it over to the charitable lead trust, which can still get a benefit for those charitable deductions, even though your client can't get any benefit from the charitable deductions because they're capped out. Now, speaking of income tax benefits, I need to mention there is another kind of animal that unfortunately goes by the same name, except it's slightly different, and that is the Grantor Charitable Lead Trust. I say unfortunately because this is not an estate tax planning vehicle at all. This is an income tax planning vehicle. Now, it looks a little bit similar. The donor shifts that asset into their charitable lead trust. It pays out for a period of years to the charity. But what's different is then anything left over comes back to the donor at the end of that fixed number of years. Now, why do we do this? Well, we do this because we can right now today, we can actually take an income tax deduction for all 10 or 20 years worth of that charitable giving that's going to be taking place. So we take an immediate income tax deduction, and the value of that income tax deduction is, of course, dependent upon the interest rates. So if you're in a high interest rate environment, the deduction might be worth, say, half what it is in a low interest rate environment, just using some examples here. Now, why do we want to use this? We want to use this when the client is planning to make these charitable gifts for a number of years. They need the income tax deduction this year. Maybe there's a spike in income, or maybe we're targeting this year as an itemizing year, but they want to get that income producing asset back. So this is why we would use this instrument, and we wouldn't use a donor advised fund, because of course, if you put an asset in a donor advised fund, you never get that asset back, right? The same with private family foundation. But here, this is for an asset that the donor wants to get back after that period of time. They can still take an immediate tax deduction for all 10 or 20 years worth of that giving. And by the way, there's some folks that do a fairly high volume of these. So these can be set up with a relatively low cost. One of the attorneys that does a lot of this is at iclat.net. Now let's talk about this. This is an obscure charitable planning technique, but it's super simple, and it can be super powerful for the right client in the right circumstances. So I want to let you know about it because it's so powerful right now today. And that is the retained life estate deed for homes and farmland. So what is this thing? Well, this retained life estate deed, also known as a remainder interest deed, gives you the right to own the property, gives the charity the right to own the property after a person's life. It could be for a fixed number of years, but it's almost always used just after a person's life. So very straightforward. It's a form of estate planning, right? However, unlike a will or living trust document, a remainder interest deed is not revocable, and it can even be sold. So that retained life estate deed, to be deductible, is transferred by a deed. You can't use a trust, can't use a contract. It's just transferred by a deed. In fact, it's a really simple deed. It's just standard deed, but you change the language to say this deed transfers to John A. donor for life, remainder to the charity that you name. Okay, so this is something for those of you that have suffered through law school and Blackacre back in property law. this is a very old concept. Well, this very old concept can create really massive deductions. So let's look at an example of this. So let's suppose we've got a client, not that old, 55 years old, and they are going to donate the inheritance rights to, let's say, $1 million worth of farmland to a charity. Well, if they do that through this retained life estate deed, they can right now today get a massive tax deduction for giving those inheritance rights. Now, again, this tax deduction depends upon the interest rates. Right now, that tax deduction would be at about $800,000. If we'd done it a year ago, tax deduction's over $900,000. If we do that in a high interest rate environment, that same gift gives you a tax deduction of $122,000. So you see how this deduction is so interest rate sensitive. Now, of course, if your client's older than 55, the deduction gets larger. If they're younger than 55, the deduction gets smaller. This massive deduction can be powerful in a lot of ways. Obviously, we can use it if we want to offset some income spike, and just like any other charitable deduction, if we can't use it this year, we can carry that deduction over for several more years into the, carry it over for several more years into the future, five additional years into the future. Another strategy where this can be powerful is that you can use the tax savings to buy life insurance for the other heirs. So you're saving a bunch of money on taxes. You can take part of that savings, buy some life insurance so that the heirs are not left out completely cold. Now, you can also just donate the inheritance rights to a share of the property. So it could be, you know, you could say, describe this part of the property, or it could be, say, a 10% interest or 20% undivided interest in the property as a whole. That's fine as well. So this is, again, you could leave the land to the charity by will. The big advantage of that is you can change your mind, but there's zero income tax deduction. Of course, you get an estate tax deduction. There's zero income tax deduction for doing it that way. However, with the remainder deed, you can't change your mind, but you get an immediate income tax deduction. By the way, if this also changes the client's financial situation, because they're going to have more liquid resources to manage, because that deduction is going to reduce the amount of money they're going to have to be sending to the IRS, and consequently, they're going to have more liquid funds, which typically the land itself is not going to be funds that you can manage. Now, this works for farmland. It also works for any personal residences. Now, that personal residence can include a second home, a vacation home. It can include even a boat with bathroom, cooking, and sleeping facilities, as long as it's occasionally used by the donor as a residence. So all of these things are possible. Now, the deduction for the personal residences is a bit more complicated because there is some depreciation estimations you have to include in there, but that is still a possibility. Also, do have to keep in mind, because this is transferring some of the ownership interest, we can't have a mortgage on the thing that we're transferring the inheritance rights to. So this would need to be something that we need to move the debt off of before we make this gift, because otherwise it's going to trigger the transfer clause in the mortgage. So some other things to keep in mind. This is one example of, but a very powerful strategy, is that charitable planning devices such as charitable gift annuities, gifts of remainder interests in homes and farms, and charitable remainder trusts, all of these things, and we'll talk about some of these in more detail in just a moment, they produce amazing tax advantages. You can reduce income taxes, you can help with capital gains tax avoidance, you can help with estate taxes. But at the end of the day, one of the things we've got to keep in mind is that something's going to go to charity. If something goes to charity, that's going to reduce the inheritance of heirs or other family members. Life insurance can actually help with this process. So we can take some of those tax benefits and we can use those benefits to purchase life insurance. So let's take a real simple example. Suppose you've got John, age 65. He's at a 37% federal income tax rate. He owns $100,000 of farmland, He wants to use it for the rest of his life and then leave it to charity, but he also wants to benefit his heirs. Well, if he goes ahead and donates the inheritance rights to charity, creates a deduction of about $80,000 today, that's worth about $30,000 in tax benefits. And suppose, depending upon how he qualifies, that'll purchase a paid-up policy of about $50,000. Well, that's kind of a nice solution because John keeps lifetime use of the farm. The charity gets 100% of that farmland at death, and the heirs get $50,000 from life insurance. And of course, if we want to, we can set that up in an ILET to make that life insurance estate tax free. Let's talk about another instrument here, the Charitable Remainder Trust. There's been lots of talk about the possibility of some of this no longer being available in the new year. So we want to know what it is so that we can take advantage of it before this potentially disappears. Two powerful things that come from a charitable remainder trust. One, you can avoid capital gains taxes, and two, you can get a tax deduction. So let's take a look at how this works. Let's suppose you have a client with a highly appreciated asset. Maybe it's some developable land, maybe it's shares of stock, maybe it could be some other form of asset. Option one, we sell it, we pay the capital gains tax, and then we earn income, but only on the remaining amount, right? If we just consider the federal taxes, not even looking at state taxes here, that means that $1 million becomes $762,000 that's left to invest. However, we can instead transfer it to a charitable remainder trust, and we can sell it with no upfront capital gains tax. Why is that? Because it's the charitable remainder trust that's going to be selling that highly appreciated asset, and that charitable remainder trust is a charitable entity. It does not pay that capital gain tax. That means we have the full $1 million left to be able to invest. So the charitable remainder trust generates an immediate income tax deduction, even though the donor can manage the asset and receive payments for life. So we not only can sell that asset with no upfront capital gains tax, continue to invest and earn income off of the entire amount, but we also get an immediate income tax deduction. This creates a scenario where you can ask, does it pay to be charitable? Let's look at an extreme scenario. Suppose Priscilla wants to sell $1 million non-income producing zero basis asset and then spend the interest income of 5% while leaving principal for heirs. She's got combined state and federal tax rates. Let's put her at, well, here it looks like we're just using the federal tax rates. And so we're not counting state tax rates, which makes it a bit more extreme when we add in the state tax rates. Again, we could do the normal thing on the left. We sell it, we pay the capital gains tax. We've got $762,000 left. We make a 5% return on that. She gets $38,100 and then leaves it to heirs, which is subject to estate tax. Another strategy is we stick it into the charitable remainder trust. The trust sells that asset with no upfront capital gains tax. It has the full $1 million. It earns 5%, pays out that $50,000 a year annuity, and also creates a charitable tax deduction of $300,000. It's going to be worth about $111,000 in tax savings. So we take that tax savings and some of the extra income that's being generated, and we use it to purchase a life insurance policy. Stick that life insurance policy in an irrevocable life insurance trust so that we can keep those funds tax-free. The client, even after paying all those life insurance premiums, they're paying those premiums with the extra income. They get about the same income. The heirs receive about the same amount, but the charity also ends up with this $1 million gift. Now, this for the advisor creates a tax-free growth environment. So that tax-free growth environment and charitable planning in lots of different ways creates tax-free growth environments. Growth inside a charitable remainder trust is tax-free. It's like a traditional IRA. Only the distributions are taxed, not what goes on inside the trust. Growth inside a donor advised fund is also tax-free. Growth inside a private family foundation is tax limited. It's only the 1.39% excise tax rate. look, I don't need to say anything new to you, but you know, if you're managing funds in a tax-free account, those funds are going to be growing faster than if you're managing them in a taxable account. Some things to keep in mind. One of the things when it comes to advising this kind of money is that when we set up charitable funds, private foundations or donor advised funds, that money is easier to advise. This creates a big pool of money that's not divided at every generation in when the client passes away. There's no estate tax, there's no capital gains tax, there's no, or at least very minimal, income taxes. So you're able to keep that pool of funds intact and grow it tax-free over multiple generations. Traditional inheritance, that's a lot harder to do. You start dividing up that money by all of the heirs at each generation. You also have to pay some of these estate taxes. There's taxation at each generational transfer. There's taxation on all the earnings. And at some point, you're going to get some greedy spendthrift heirs that are going to spend it all on themselves. Much less likely to keep that money, those funds intact along the way. Now, I mentioned that the funding the charitable gift annuity with cash should qualify for the 100% income limitation. I do not believe that funding the charitable remainder trust will qualify for the 100% income limitation. Why is that? Because the charitable remainder trust is not a public charity, a Section 170B1A organization. So no cash in 2021 will go to that Section 170B1A organization. Now that's different than a gift annuity. A gift annuity, the organization gets all of that cash. The donor retains no rights in that cash or property that's transferred to the charity under a charitable gift annuity. With the charitable remainder trust, that's not the way it works. The Section 170B1A organization doesn't see a dime of cash until the very end, whether that be at the end of the donor's life or 20 years or whatever the period may be. So for that reason, I don't think it qualifies under these words. So some benefits of the charitable remainder trust: income with no upfront capital gains tax, and you get an immediate tax deduction. Now, just a quick side note, there was an issue where a charitable remainder annuity trust would be disqualified if there was a greater than 5% chance of exhaustion due to the annuitant's longevity. We can now draft around that. There's a revenue procedure that says, here's some saving language that allows you to draft around that so that you can still use that charitable remainder annuity trust. So a charitable remainder annuity trust increases assets under management. Number one, there's no upfront capital gains tax at the sale. Number two, there's tax-deferred growth within the charitable remainder trust. Only the distributions are taxed. Number three, you get an immediate tax deduction. And number four, you can get post-mortem management if that CRT is then paying out to a donor-advised fund or a private family foundation where the funds can continue to be managed. So you have multi-generational management. By the way, all of this crazy list of tax benefits that are stacked up leads to the question of, is it better to use a charitable remainder trust with appreciated assets, even if the client's not particularly charitable, as compared to simply selling the asset and investing after-tax dollars? So a finance professor ran this with a Monte Carlo simulation over 3 million retirement lifetimes. By the way, he used for the lifespans the annuity purchaser table, which is not the table that the IRS uses. So that's one of the reasons this deduction is massively overstated, because the IRS uses the life tables for all of the population, but sick people don't buy annuities. That's why we use a different life table for annuities. So what was the result? The result was that actually the charitable remainder trust with the minimum 10% payout to charity actually outperforms the direct investment. So in this 1 million Monte Carlo simulations, in the direct investment, the plan failed 9.9% of the time. In the charitable remainder trust, the plan failed 7.9% of the time. However, the difference was even much more massive for that than that, because if you fail in the direct investment, that means you run out of money. You're broke. If you fail with the charitable remainder trust, that just means that your payments start getting to the point that they are below your target amount. So on the left, the failure is $0. On the right, the failure is a bit below the target amount. Actually, there's more for heirs if you just save that extra money that you get from the charitable remainder trust. That may be one of the reasons why this is actually some possibility of this being eliminated in the new tax law, where you will have to pay those upfront capital gains taxes for the share that is projected to go back to the donors. So might want to do this before the end of the year, because we may not have this strategy at the end of the year. Hey, I'm about out of time, so I'm going to close it up here. If I had time, I could talk about all these other cool things that we could do with multi-generational planning. Do keep in mind that we do have more benefits from tax planning. We do have the $300 per person deduction above the line. Let me end with this, because you're going to have, I think, clients more and more interested in Roth conversions. Do keep in mind that if they've already got, let's say, a pledge they've made to charity, accelerating that multi-year pledge by writing a check now can help offset that Roth conversion. We can wipe out up to 100% of income. And let me end with the wonkiest thing, but since we're coming up on the end of the year, do keep this in mind. If you've got clients that are using the qualified business income tax deduction, remember that income tax deduction, as income goes up, it phases out. Nothing unusual about that, except this one really important thing. It's the only animal that we have that phases out based upon taxable income. That means if you've got a client that otherwise would qualify for this qualified business income deduction and they have phased out because of their income, if they're charitable, they can phase themselves right back in, because this is based upon taxable income. So if you've got a client in that space, they not only get the charitable deduction and the benefit from the charitable deduction, but they get a double bonus because they can basically phase themselves back into the qualified charitable, qualified business income tax deduction. All right, that's a bunch of stuff. I think I've hit the right time, Pragya. If not, I'll talk more about some of these things, but if my timing is right, I think we can open it up for questions and comments.
Yeah, thank you, Dr. James. It is 9:47. Before anyone has any questions and put it in the chat, that would be great, but please fill out the mandatory CE and the evaluation form and submit it to us by noon if possible. Any questions, just feel free to email me. Tom, did you want to pose that question that we had regarding Medicaid? Maybe Dr. James can elaborate on that.
Oh, actually, yeah. So there was a question that came up, Dr. James, about whether gifts that are made are subject to Medicaid look-back periods. And so, thankfully, because we have a number of estate planning attorneys on the session, Rob Scalaro, one of our local experts, responded to that question and talked about how Medicaid does consider any gift, whether to an individual or charity, as a gift, and that the donor must get through the 5-year Medicaid look-back period. And that's true for, just basically the charitable planning in general. Another question that come up early in the presentation was from Nick Kagi, and he asked about, state treatment of like the qualified charitable distribution. Does New York State view that as tax, free, where it bypasses, the return? And also asked about the capital gains. Does it matter how the state treats capital gains, or does the capital gains avoidance, just happen with charitable gifts, just like it does at the federal level?
So unfortunately, coming from Texas, I can't give you any guaranteed answers on New York law. I haven't seen any situations, and maybe other folks could chime in, where the QCD doesn't work under state law. But if anybody has seen that circumstance, please feel free and chime in. I haven't heard of this happening where the QCD is recognized as income under state law, but out of my bar license territory here, so I can't give you a New York specific answer on that one.
Great. Yeah, I have not either. So I think that it avoids the capital gains and it avoids the state, treatment of the QCD. So
Yeah, I would have heard some people screaming if it didn't, and I haven't heard that. So I
Right,
think we're
right.
good on that.
Yeah, one thing I just wanted to bring up from your research slides, one of the things that you did was you aggregated basically all the people that had some interest level, whether it was strong or only a little bit. And those percentages totaled to less than half in most cases. So like, I just wondered if you wanted to talk a little bit about, the general percentage of, people in our planning world that really are charitable and do these kinds of charitable gifts.
Yeah, so it's one of the things to keep in mind that obviously you need to have someone who's charitable and you need to have someone with appreciated assets. Well, that second part kicks out a bunch of people. And so beyond that, where I see is the real gap is there's a lot of people who are charitable, who have a lot of appreciated assets, and they simply don't know that there are smarter ways to give. And that's really the space where, honestly, even at speaking to FPA meetings and speaking with financial advisors, a lot of them don't know some of the, not to mention the super complex stuff we talk about here today, but even some of the very straightforward things about going ahead. If you've got a client who's making gifts of cash, let's shift those gifts over to appreciated assets, and how we can do that. If they're owning, say, individual securities, how we can try to use that in a way that gets the capital gains tax out of the portfolio. Some of those very straightforward approaches. Sometimes if donors aren't engaged, if advisors aren't engaging in these conversations, then they may not know that there's opportunity there, because there's a lot of missed tax planning opportunity in this space. And frankly, to have these conversations with your clients about their philanthropic goals can really strengthen the advisor relationship, where it's not just a matter of, you're trying to beat the market by 3 basis points, and that's why we should be your advisor, that you can move into more of what you might call a life planning, values-based planning, because those type of approaches tend to lead to much more stable, longer term relationships, even if you happen to underperform the market in this quarter or that quarter. So I think these are good conversations for advisors to have, not only from a philanthropic impact perspective, but also just from a perspective of maintaining the strongest relationships with clients.
Another question that had come up during the presentation was just whether the community foundation had seen any increase in charitable lead trusts, because of the low rates and the other aspects that you discussed there. And so I responded to that by saying that we've seen some additional inquiries, but we haven't seen any more where we're the trustee. The most common case for us in dealing with charitable lead trusts is just being the designated beneficiary, where we just receive the payment from the charitable lead trust each year. We do trustee those like we do charitable remainder trusts, and so that is an option. But that actually fits right in with where we want to be with all the professional advisors in our community. We love when advisors reach out to us with just the inquiry, the question, because we love to be able to point them in the direction of the different ways that they can achieve, that planning opportunity that they have with their client. And sometimes that's with us and sometimes it's not, which is absolutely fine from our perspective. It's sort of the rising tide, lifts all boats kind of situation. And so, but yeah, I would encourage everyone on this call, and you can share that with all of your professional advisor colleagues, that we're here just as a resource to ask questions. And obviously, we have relationships like, presenters like you, Dr. James, where we can reach out and ask questions too. And I mentioned in the chat that we have partner foundations that we use for certain complex gifts. Like if we had a cryptocurrency gift come up, we wouldn't be doing that through ourselves. We'd be using, a partner foundation to do that. So, and we have a network of, 800 community foundations nationwide that we can reach out to and that we engage with on a regular basis. And so that is absolutely, a resource that we can bring to bear for any of you on the call. And that's part of why we do this every year. It's just, we're so appreciative of the advisor community. That's where most of our relationships come from, fund-wise, new fund creations, legacy plan creations. I also wanted to note one of the tools that we use, and you mentioned this, Dr. James, about, retaining assets under management. We have what's called a financial advisor program account, where for gifts that create funds that are $500,000 or greater, the financial advisor, at the donor's request, can be involved with the management of that going forward. It doesn't have to go into our main pool. We can do a separate pool, and the advisor can retain that relationship, and that can lead into next generation opportunities as well. And so legacy planning opportunities too. So I didn't see any other questions that came through. If I missed a question, please feel free to enter that in again or unmute and ask it now. I feel like we're probably at a pretty good place with respect to the questions.
I didn't see any other questions at all. I think I'm just checking. Okay. No questions. We had a lot of questions on the CE. If there's still any confusion, please feel free to reach out to me, and I can help you out with that. Dr. James, thank you again for your great presentation early in the morning from Texas. I appreciate it. And again, thank you all for attending our seminar, in a virtual format in 2 years in a row now. So thank you. And if you'd like to learn more about the Community Foundation, all the things that Tom mentioned, the legacy and the lifetime giving services we provide, and also the financial advisor program and how we work with the advisors in the Central New York region, reach out to me, Pragya Murphy. Dara can put our emails on the chat box right now. Tom Griffith's here, and then Jan Lane and our development team. Thank you, everyone, and hope to see you all soon again.
Thank you, everybody. Thank you, Dr. James. Thank you, Pragya. Tom,
Thanks, Rob.
great presentation.
Thank you,
Dr. James.
Thanks. Glad to have you here.
That just flew by, the 2 hours. Didn't even feel like 2 hours. I'm gonna have to listen to some parts again because I was busy trying to answer people's questions on chat box and email, but yeah, thank you.
Yep, wonderful. Hopefully the sun is up where you live. So
It finally is. Yes, finally is.
That was so much content in 2 hours. I'm so impressed.
Hi, Lindsay.
Hi.
Yeah, thank you. Is this your first one attending?
It is. It
oh,
is.
Great.
I knew several of the other attendees from Dermody Burke and Brown or attorneys, but this is my first time and it was well worth the time. So thank you.
Yeah, Tom, Lindsay just joined. This is just Catholic Charities or guys?
In January. Yeah, Tom and I have actually connected.
Okay, good, great.
But I took like 2 pages, 3 pages of Word notes. So thanks.
That's
Have a
awesome.
good day.
Everybody have a
You
good
too.
morning. See you
Enjoy.
later.
Thanks, you too.